Hi, in this video we will be going over the steps to journalize and post transactions. So the journalizing and posting process has 5 steps. I have them on the screen, step 1, 2, 3, 4, and 5. Let's go over these and fill in the blank. So step 1 is to identify the accounts and the account type. So identify the accounts and the account type. Is it an asset, a liability, or an equity? Okay. Step 2 is to decide whether each account increases or decreases, and then apply the rules of debits and credits. So you have to do step 1 before you can establish step 2. Okay, and step 3 will be record the transaction in the journal. Record the transaction in the journal. So we've identified the accounts, if it's an asset, liability, or equity. Remember, there's always going to be at least 2 accounts that are affected. Determine whether each account is going up or is going down, and then establish the rules. Step 4 is going to be posting. Post the journal entry to the ledger. To post just means to copy the information from the journal to the general ledger. And remember, the general ledger, we use a T account to represent the general ledger. And step 5, determine whether the accounting equation is still in balance, which is assets equals liabilities plus equity. Okay? All right. Next, let's go over some examples. Transaction number 1. It says, on November the 1st, the e-learning company received $30,000 cash from Sheena Bright, and the business issued common stock to her. We did the same transaction in Chapter 1, but we recorded it in the accounting equation, and we proved that assets still equaled liabilities plus equity. Okay, so we have $30,000 cash, and we have issued common stock. So going back to the steps, identify the accounts and the account type. We have cash as an account, and we have common stock. Okay, cash is an asset. Okay, right here, cash is an asset that is increasing, and we have common stock is an equity, and that is increasing, so that is a credit. So we've already done step 1, identify the accounts, cash and common stock. Number 2, both of those accounts are going up. Number 3, record the transaction in the journal. Let's do that. Here's the journal entry. Notice you've got a date. This is journal paper. So this first column we have a date. The second column we have for space for the accounts affected. So cash and common stock. Notice there is a brief explanation. That's just kind of summarizing that transaction. We issued common stock to Sheena. Credit account name and the dollar amount. The credit account name is indented. See this right here? Common stock is not directly below cash. Any account that is being credited gets slightly indented to the right. Okay? Your debits are always listed first. So debit is listed first. And then common stock, credit 30,000. Debits and credits always have to equal. Okay, debits equal, oops, let me draw a C. I need to get a stylus. Okay, debits equal credits. And the next step after recording it in the journal, remember that term was post. So now we're going to post that journal entry to the general ledger, which is the T accounts. Okay, I've got cash November 1st, 30,000 debit. Common stock, November 31st, 30,000 credit. And you can see the accounting equation remains in balance. Okay, 30,000 on this side, 30,000 on this side of the equation. Next transaction, we have November the 2nd. Smart Touch Learning paid $20,000 cash for land. So we have cash, okay, we've got cash, that is an asset, and we have land, that is also an asset. So in this transaction, cash is going down and land is going up. So cash is an asset that is decreasing. So that's going to be your credit in this journal entry. And land is the asset that is increasing, so that will be your debit. So let's get to the transaction in a journal entry. Okay, so this journal entry, land will be the debit, and the dollar amount oh, excuse me, is 20,000, and cash is your credit for 20,000. And so next we will post that transaction to the general ledger or the T account. So cash is going down, that is a credit, and land is going up, that is your debit. Okay, and now we can determine the ending balance in cash, and it is $10,000. We had 30,000 on November the 1st, and cash just went down by 20,000 because we purchased land, so our ending balance now is $10,000. Okay, and now you can see how the accounting equation is affected. We've got $10,000 cash plus $20,000 land. We have 30,000 on this side, and we still have 30,000 on this side. So our equation remains in balance. All right, let's do another transaction. So transaction number 3, we are purchasing office supplies on account. So Smart Touch Learning pays $500 of office supplies. That's an asset. On account, accounts payable, that's a liability. Okay, so office supplies is an asset. That is going up because we're buying additional office supplies. So an asset going up is a debit. Okay, so office supplies will be your debit. And we have account, on account. That means that we have not paid for it yet. So we have an additional debt that we have to pay. And that we're going to call that accounts payable. There it is right there. You've seen accounts payable already in the chapter and in chapter 1. Okay, so that will be your credit. You've got a liability going up. That is your credit. Okay, and next we will post these to the T accounts. Okay, office supplies, that's an asset going up. Accounts payable, a liability going up, is your credit. Okay, next we have transaction number 4, earning of service revenue for cash. So on November the 8th, Smart Touch Learning collected cash of $5,500. For service revenue that the business earned by providing e-learning services for clients. So we have cash as an account, that is an asset, right? And we collected the cash, so that is going up. So an asset, cash going up, that's you already know your debit, okay? So we've got cash, $5,500. Service revenue, that's a component of equity, of retained earnings. It affects equity and it makes it go up. Okay, so our service revenue is going up. That is your credit. Service revenue. And then posting this transaction, cash going up, and service revenue is a credit. Okay. And that's transaction 4. Transaction 5. On November the 10th, Smart Touch Learning performed services for clients for which the clients will pay the company later. That is an asset. That results in accounts receivable. These customers haven't paid us. They owe us money. They will pay us in the future, which is an asset because it will benefit our company in the future. Okay, it will turn into cash at a later date. So that's one account, accounts receivable, and that is an asset and it's going up. The perform services part for clients. We have service revenue. Smart Touch has done the work. They have performed service for a client, so they have earned the $3,000. Even though Smart Touch is not collecting it in cash at this date, they have earned the right to that cash. All right, so your accounts receivable, and service revenue. Accounts receivable is the asset and it's going up. Okay, so accounts receivable is going up, $3,000. Service revenue is going up. That's your credit for $3,000. Okay, and now service revenue, we now have a total of $8,500. Okay. All right, transaction number 6. Smart Touch Learning paid the following cash expenses on November the 15th. See, the date has already been given to you in all of these examples. So that's already been filled in. What we've been doing is filling in the accounts here in this column and then the debit and credit amount. Remember, debits always have to equal credits. You always need to apply the rules of debit and credit. Okay, so let's fill in this journal entry. Applying the rules of debit and credit. I've got my accounts already filled in. I've got rent expense as a debit, salaries expense as a debit. When expenses go up, the normal balance is a debit, and cash is going down. Cash is an asset, so that will be our credit account. So rent expense, $2,000, and salaries expense debit, $1,200. So now cash, just total those, the total cash being paid out or the total cash going down or decreasing is $3,200. And look here at the bottom, we've got a note. A compound journal entry is a journal entry with multiple debits or credits. So in this one, we've got 2 debits and 1 credit. You could have 1 debit and 2 credits as long as the accounting equation and the journal entry, or excuse me, debits and credits equal. So you've got $3,200 on this side and $3,200 on this side. Okay, and posting these now, we've got cash credited $3,200, rent expense that was $2,000. And salaries expense, $1,200. For this next journal entry, we have Smart Touch Learning paid $300 on accounts payable. So we've got $300. That's a cash account. That's an asset going down. So that is a credit. And you've got accounts payable that's also going down because we're paying down our liability. That liability is going down. That is a debit. Okay, so that's our journal entry. Posting this, let me put cash there. So posting it would be accounts payable is a debit for $300 and cash is a credit for $300. Okay. So this video was recording transactions 1 through 7. I will continue in an additional video.